All right, let's move on to what are you doing next? Zoom.
Zoom. Yeah.
I was so excited about this because I know Zoom came out during COVID, went way up. I'm thinking maybe now there's a value play here, so I thought we'd take a look at Zoom, symbol ZM, then the software application, and we use Zoom all the time. I think everybody uses Zoom, don't they? Seems that way.
I mean, the problem is there's more competitors now. I know some people use Microsoft
Yeah.
Teams. There's Google Meets. So I think Zoom is still the easiest to function. Like
Right.
you don't have to have a Microsoft account. It's very easy. If like we send a link to somebody, just click it and
Yeah.
join the Zoom. So I think they've got the best product personally. But
Yeah. Well, let's go to the numbers on Zoom. Their symbol is, I love the symbol, ZM. Just sounds cool. PE ratio 21.4. That's half the industry of software applications at 58.3. Price of sales 5.4 versus 6.6. Price to book value 2.7 versus 6.9. Price to cash flow 13.3 versus 31.5. So these are valuation ratios. You want them lower than the industry average. Zoom does that, and they have a PEG ratio of 0.9, which shows you how much you're paying for the future growth of that company going forward. That's a very good number as well. Looking at the earnings growth of last year, they did very well. Over the last year, the earnings were up 35.7%, double the industry at 15.6. Sales climbed by 3.6%, not quite as good as the industry at 5.4. 5-year growth rate for Zoom from the analysts is a 16.7, so that's pretty positive. Unfortunately, they do not pay a dividend yet, and maybe in the future they will, but right now they're still considered a growth company. And I say yet because I looked at the current ratio. It's 4.5 versus 1.7. They have a lot of liquidity on the balance sheet and no debt. The industry's at 0.5. So I like the nice balance sheet they have here.
are they buying back stock? Can you see the stock buyback yield?
I don't see it here. I'm sure it's there. I can maybe look at it when you're doing your numbers there. But we do see and I love the net profit margin. Wow, 25%, doubled the industry at 12.4. Return on invested capital, 13.2. Free cash flow, 1.8. I believe it's $1 billion versus 2.9 billion. So that's good. So I'm liking what I'm seeing here. It depends on what you say. What we're going to get going forward.
Yeah, so current price here for Zoom, again, their ticker symbol is ZM. It's $81.42, 52-week range. The low here is $64.41, and the high, $92.80 year-to-date. The stock's about flat, but this is where it gets crazy. The 5-year return down 75%. You ready for this? The all-time high for Zoom, October 18th.
Wait, let me guess. I don't see it in front of me. 500.
Kind of close. October 18, 2020, the price was $588.
Wow.
84.
I knew it was
almost
ridiculous.
$600 a share. So,
Wow.
you know, I remember people like, oh, you buying Zoom? It's COVID. You know, you got to buy Zoom. And it's like, I mean, who knows what's going to happen here? I don't think we're going to be at desktops forever just talking to the computers. But, you know, I mean, obviously that didn't pan out if you bought Zoom back during the hype years in COVID. Now, going forward, I mean, this is kind of where it gets interesting. You go out to January 2027, you see estimated earnings per share here of $5.93. I mean, it gives you a target sell price of $98.44. So it's around 13 and a half times those future earnings. The problem that I'm seeing, very limited growth. Earnings growth is estimated to be about 5.99% this year and 0.9% next year. So you're not getting very much earnings growth. Sales growth is estimated to be about 3.5% over that time period as well for each respective year.
And I got a comment. This is why we look at two different companies that do the analysis here. The one I'm looking at shows earnings in January 2027 of $3.48. They have 11 analysts. The low is $2.90. The high is $4.56. So the one you're looking at, they must have some analysts in there that are very high to bring that up to like $5 a share or whatever.
What was your low?
$2.90.
So I don't have the 290. I think that's the big difference. My high is 644 and my low is 540.
Yeah.
I have 31 analysts. How many do you have?
11.
11.
Yeah.
Interesting.
So, yeah, that's something that,
I don't think I would buy it, obviously, based off those numbers. But, and the other thing, too, that worries me about Zoom is, again, I kind of talked about Teams. I talked about Google Meets. You know, do they have anything that is going to make it kind of exclusive, right? Like, you kind of look at, is it going to be like GoPro, where GoPro was all exciting for a little bit, and then GoPro is not exciting anymore. I think it's a like multi-million-dollar market cap now. I don't know if Zoom could go that route where it's like, we're not going to acquire you. we're just going to do what you do better. And then
Right.
Zoom would just collapse.
I will say one thing I think they have is a benefit of the name. It's kind of like with Xerox. Oh, just take a Xerox copy.
Or just Google.
Yeah. Well, what?
Just Google.
Just
you know?
Google. Yeah,
Google
just Google.
it.
Yeah. So yeah, just Zoom me. You know. So they got that, but that is worth something. But I don't like the discrepancy that we have in the earnings going forward. And also, you said the growth rate going forward does not look that good.
Yeah, I mean, if you're going to only be growing earnings around 5%, I want to get, again, around probably a 10 times earnings multiple, not a 13.5.
But remember what I have here, the 5-year earnings per share growth estimate from the analyst is 16.7 for the next 5 years. So tough. Yeah. And again,
I'd rather look at the earnings estimates. Sometimes that earnings estimate over the 5-year period, it's going to be weird if they had like a write-off or something last year. It's going to charge that number. So I'm like, I don't think the earnings growth is that pretty.
Yeah, and what we look at too is like if there's something wrong, we're not going to say, well, yeah, but this is higher, so let's go with that. We will always take the other side of the coin saying, you know what, yeah, it looks too good to be true. We'd rather miss something that went up than count on something where the numbers are maybe too high and we got too excited. We look at buying things that are not risky and not on all the hype, but based on values.
Yeah.
So, yeah.